The 2023 recession just hit Home Depot, who just posted their worst revenue miss in 20 years, as homeowners are now pinching pennies amid concerns about the economic outlook. A slowdown you can see reflected in Home Depot's financials, which are now reporting a 9% year-over-year decline in net earnings. Because a big problem for Home Depot is the fact that the US housing market is in a downturn, with data from the National Association of Realtors showing that existing home sales have collapsed back down to 4.3 million on an annualized basis. That's basically at the lowest levels in 2 decades and comparable to what occurred in 2008 at the beginning of the last crash. So few home sales means that there's going to be less opportunity for people to buy appliances and furniture or to do renovations, and thus you can see why Home Depot is struggling. And what concerns me and what should concern you out there is that this situation is likely to get worse throughout the second half of 2023 because mortgage rates are now going back up, with the 30-year fixed mortgage rate now going back up to 6.8%, a figure which is another nail in the coffin on the US housing market because people just simply cannot afford to buy homes in today's market, with your monthly payment to purchase a house now running $4,500 a month in New Jersey, $3,500 a month in Dallas, and $2,900 a month in Nashville. And what scares me is the Federal Reserve of America. They seem like they might want to increase interest rates even further in the future, with the Dallas Fed president saying that current data doesn't justify pausing rate hikes yet. Lori Logan said that while there's been some progress in bringing down inflation and cooling the labor market, she says the Fed still has work to do in achieving its goal for price stability, which means that she's likely going to vote for another rate hike increase in June since she's a voting member. However, Jerome Powell just came out today and insinuated that the Fed is unlikely to hike interest rates in June, with the betting markets now assuming that there's a 78% chance that the Fed stands pat and short-term rates stay between 5 and 5.25%. However, what the Fed does in June doesn't really matter because they've already inflicted so much damage on the economy through these interest rate hikes that they're eventually going to be forced to pivot because the economic downturn is going to get so bad that they're just going to have to cut rates. And the reason that I'm predicting this is because I'm looking at the bond market and what the bond market is saying, particularly in terms of the yield curve inversion that's taking place right now. As you can see on this graph of the US Treasury's yield curve, where the short-term yields between 1 month and 1 year are all above 5%, meaning that if you were to buy one of these government bonds, you would get around 5 to 5.5% interest. Now, here's where things get weird with this inverted yield curve. If you were to buy a 10-year US government bond and commit your money for much longer, you would only get a 3.7% interest rate. And if you were to buy a 30-year bond, you would only get a 3.9% interest rate. And this is not normal. A normal looking yield curve in a healthy economy would look like this, with the longer term bonds offering higher returns than the shorter term bonds. And ultimately what today's situation is saying is that the bond market doesn't believe that these short-term yields are going to last into the long term. The bond market is saying that 5%, 5.5% short-term rates and a 6.5%, 7% mortgage rate, that's not going to stay for too much longer because the economy can't handle it and the Fed's going to have to cut. Because going back through US history, every time we've had an inverted yield curve where the long-term yields are lower than the short-term yields, like you can see right now, every other time we've had that, it's directly preceded a recession. But of course, it's not just the yield curve predicting recession. It's all these publicly traded companies, it's US consumers, it's a company like Target, whose quarterly profit just dropped as the company wrestles with a pullback in spending as well as theft that may cost it more than $1 billion this year. Digging into the data specifically, you can see that Target's net earnings were down 6% from where they were a year ago. And historically speaking, when we see these profits decline for these big corporations, that's the predecessor to seeing the big increase in unemployment. Some of you might remember a video I did 3 weeks ago where I talked about Michael Kantrowitz's HOPE index for the US economy. HOPE is an acronym standing for housing, orders, profits, and employment. And thus far, housing, orders, and profits have all gone down while employment hasn't. But that's a situation that's unlikely to last for much longer, especially now that we're starting to see an uptick in unemployment claims in America, which you can see have bounced from a low of 182,000 per week in September 2022 up to a range of about 250,000 per week in May. And ultimately, the hope for you as a home buyer who's waiting for a better deal is that this increase in unemployment claims and the recession is going to cause a wave of forced selling on the US housing market as people all of a sudden lose their jobs or get their hours cut back and have liquidity needs that cause them to have to sell their house. And this is a trend we are not yet seeing. Sellers on the US housing market are still very stubborn. Inventory is still very low. In fact, it's close to record lows. One of you actually emailed me this chart on housing inventory in America going back to 1999. And what do you see? Inventory on the market today in 2023 is exceedingly low, close to the lowest levels of all time. And the implication here, especially from the person who sent me this email, is that even with all the factors that could cause significant declines in prices, doesn't the lack of supply overshadow all the other factors? And perhaps in the short term, it might, because so long as sellers remain stubborn and don't feel like they need to sell, it's going to keep homes off the market, and that's going to put a floor on prices. However, what's fundamentally important to remember is that we do not have a structural shortage of housing. There is no structural shortage. There's more than enough houses to go around. What we have is a cyclical shortage where only 0.7% of all the single family homes in America are listed for sale. And the reason that there's such low cyclical inventory is because the US government pumped all types of money into the economy over the last 3 years. They artificially suppressed interest rates, they did foreclosure bans, and they distorted the market. However, there's nothing sustainable about those things in the long run. And in fact, such low inventory and such a high price and mortgage rate environment creates a very unstable system that's due to come crashing down. I mean, take a look at Austin, Texas, for example. Home prices in Austin are down anywhere between 10 to 20%, depending on the source you look at from peak, with some listings in Austin like this one being down by over 30%. The value of this home was $580,000 a year ago. Now it's listed for $395,000. And so why are prices in Austin crashing so much and so fast? Well, it's because inventory went up, with the number of homes on the market increasing from 1,600 a year ago to 6,500 today. Now, that's a big increase in inventory, but what do you notice, folks? 6,500 homes on the market, that's just basically what it was in 2019 before the pandemic. And so what Austin signals is that if inventory just gets back to what it was in 2020 and 2019, which was still a low level of inventory over the long run, that can cause prices to go down 10, 20, even 30% in rapid succession. That's the instability actually created by a market being driven by low inventory, is that even going back to normal causes big price declines. Of course, to get back to normal, there needs to be some distress. And the distress in Austin is coming from all the layoffs that are occurring in the tech industry, with companies like Tesla and Oracle and Dell cutting staff left and right, which in my opinion makes Austin a good example of what will happen to the rest of America's housing market when the unemployment rate at a national level starts going up meaningfully. But I know a lot of you out there have been waiting for a long time, and you don't really have time to wait to buy a house anymore. And in fact, I just got an email from one of my channel members who's having this big debate about whether they should buy a house right now. He says he's been patiently waiting to buy a house and has made 12 offers in the last 9 months, most of them below ask, which didn't go anywhere. Now, suddenly he found a house that showed up a very reasonable price in a neighborhood that he wanted to be in, and he offered $30,000 over ask. Now he's under contract, and he's trying to make the decision whether he should go through with it, because he suspects he's going to lose $50,000 to $70,000 in value on his house. And ultimately, he's trying to make the difficult decision of having a nice home to live in for his family versus continuing living in a rental. And he asked, do you have any advice for this situation? And that's a tough spot to be in, everyone, especially if you have a family, right? At some point, maybe the desire and security of owning a home outweighs, the value proposition of trying to get the best deal. And if you're someone in that situation, I would say you just really need to ask yourself 2 questions and make sure of 2 things. Number 1 is, can you afford the monthly payment? Because with mortgage rates back up to 6.8%, most people who are buying today are going to be house poor. So if you are going to buy today, you better be sure that you can afford that monthly payment comfortably and you're not stretching, because you do not want to be stretching buying a house on your monthly payment walking into a recession. That's a bad situation. Now, the second thing you should ask yourself is, how comfortable are you with the idea that the value of your house is going to decline pretty quickly after you buy it? Probably is going to go down 15-20% after you buy it. If you can get comfortable with that idea and not be shocked and surprised when it happens, then again, maybe you should move forward with it, because the value of having a house for your family outweighs getting in at the best price. But if you're someone who says, no, that can't happen, no way our value is going to go down, I would say be very, very careful, because you could be in for a rude surprise. After you buy, you could end up underwater faster than you think. Another thing we need to talk about is the fact that we're in a bifurcated housing market right now, folks. folks. It's really a tale of two housing markets. Some cities are still appreciating. Other cities are seeing prices go down. And even within like the same city, you can have a very different experience as a home buyer. For instance, CNBC was reporting on some of the dynamics in the Las Vegas housing market. And they talked to a realtor who said that one house was just listed at $395,000 and saw steady foot traffic and eventually sold by Monday for full price. However, the realtor had another house listed at $510,000 where no one showed up, with the conclusion being that under $350,000 and $400,000, there's multiple offers, or over $500,000, it slows down. With data from the National Association of Realtors proving this out, they showed that there's been a 29% decline in sales between $500,000 and $750,000 and a 37% decline in sales over $1 million. So big declines in sales at higher price points, while the price range $250,000 to $500,000 is only down 20% in sales. And what's going on here is that the higher mortgage rates have basically pushed some of those mid to upper tier buyers down a notch in terms of the house they can afford, which is leading to surprisingly high levels of competition for an affordable house in a decent neighborhood, whereas the more higher end luxury market is really slow and we're seeing prices go down there by more. However, folks, I don't think this situation is going to last forever, because at some point when the foreclosure dam breaks, which could be in 3 months, it could be in 9 months or a year, what that is going to do is it's going to flood the market with lower priced inventory. Because it's usually people with lower incomes and cheaper houses that default on their mortgage and get foreclosed on. And so right now, still 2 to 3 years after all those foreclosure moratoriums where the foreclosure levels are still low, yeah, there is constrained inventory at the lower end of the market. But eventually, as the economic recession gets worse, the one that companies like Home Depot and Target are predicting, we should see more mortgage defaults and then foreclosures, which is going to flood more lower priced inventory onto the market. Lastly, before signing off, everyone, I need to talk about a big issue that's on my mind, and that's the demographic crisis that America's economy and housing market is facing. And what I mean by demographic crisis is the fact that way fewer people are having children. And this is something that at first might not seem like it's a big deal for the housing market, but it is. And let me show you why. On this graph, you can see the blue line, the number of households with a child in it peaked in 2007 at 37 million households with a child in America, which has now fallen to 34 million in 2022. So literally in nominal terms, we have fewer children in households with children in America, where at the same time, the yellow line, the number of people living alone is surging. The number of people living alone is now more than the number of people who have a child in their house, which means over the long run in America, we are going to see less demand to buy houses and more demand to rent, because after all, it's the presence of a child in a family that is the most major incentive for someone to buy. Think about the email I read earlier from the person who was deciding whether they should overpay for a house for his family, even though he knew prices would go down. The reason he's doing that is because already there's children or there's going to be children soon. Whereas someone like myself, who is single and lives alone, has absolutely no pressure in terms of the need to buy a house. And I feel like I could wait 5 years. I could wait 10 years to buy a house because I don't have the familial pressure or a child in the picture to force my hand. And so it's this lack of children combined with the aging of the US population that's over the long run going to cause those inventory levels to go up a lot. And it's not going to be something that happens in a year or even 2 or 3 years. It's a long-term trend as the demographics in this country are shifting significantly. And real quick, everyone, if you're someone who wants more in-depth analysis on the housing market, consider hitting that join button below and becoming a channel member. I post exclusive data and content to my channel members multiple times a week so you can get better insight on the housing market. So hit that join button. It's $5 a month if you want more data and access.